We have a lot of people asking us, what is going to happen in 2023 with the housing market? What should we prepare for? Should we wait it out? Should we run for the hills?
Today, we'll cover what to expect in these next few months and leading into 2023's housing market. After watching this video, you'll be prepared for anything 2023 throws your way.
Listen up, real estate investors and real estate investors in the making. There's a massive opportunity coming, and we're going to lay some foundations here so that you understand the playing field. We'll use the regular homeowner market to explain what we predict will happen to the real estate market as a whole. Then we will talk about how it's different for investors and how you can position yourself best.
To us, this is an exciting time that we've been patiently, or not so patiently, waiting for several years. So the Fed has made no secret about its intent to increase interest rates several more times in the near future. What does that have to do with the housing market and its likelihood of crashing? And how will that impact you if you're looking to buy rental property to start building your wealth and passive cash flow?
Let's begin by talking about what actually causes a housing market to crash. Everything, and I mean everything, comes down to supply and demand. When the supply of housing starts to massively outweigh demand, a crash is imminent. And to understand that better, we need to understand what drives supply and what drives demand.
So let's start with the simpler of the two, supply. What drives supply in a real estate market? To put it simply, building and renovation. For years, there's been a massive shortage of houses. Building continues to happen, but when COVID hit, we saw a massive halt in the supply chain, making it difficult for builders to get the materials they needed to complete their projects, leaving a massive gap between the amount of housing units needed and the amount available.
In addition, investors who are normally fixing and flipping and investors renovating existing apartment units had the same issues builders had. They couldn't get the supplies needed to finish their projects, and anytime there is a supply issue, meaning not enough supply, there's not going to be a market crash because there are more buyers than there are sellers, which drives prices up because in order for a buyer to be able to buy a home when there are hardly any homes to buy, they're going to do crazy things like buy without an inspection. Huge mistake, by the way. Or they're going to offer more than asking price, driving the comps and thus the value of the properties up and up and up.
The housing market has had a much longer than anticipated hot run. Frankly, we've been expecting a housing cool down, not necessarily a crash, since 2018, which is why we wrapped up the fix and flip projects that we had going on and started buying cash flow properties. When COVID hit, the government put so much effort into making sure the entire country's economy didn't plummet. They infused so much capital into everyone's accounts, artificially boosting up the financial position of a lot of people, which increased people's ability to buy, essentially creating more demand, while the supply chain issues kept units from being able to get finished and onto the market.
So we have been expecting a correction for years now. The fact that the Fed allowed inflation to get out of hand before finally making moves to adjust the rates was surprising at best. We knew that as soon as they started increasing rates, it would slow things down. But why is that? Part of what drives demand is ability to buy. And what slows down the ability to buy? The cost of capital.
Let's break this down. When people are buying a personal residence, what they can afford is based on their personal debt to income ratio. So they make whatever they make, and let's just say the bank allows for a 30% DTI, or debt to income. That means that if they make $100,000 a year, they can afford $30,000 for a mortgage payment, which computes into $2,500 a month. For the moment, we'll leave out the taxes and insurance part of things to avoid confusing everything. But when interest rates are 3.25%, that $2,500 principal and interest payment can buy you almost $575,000 of house. Bumping up a full percent, which seems super cheap right now, but let's just say interest rates are 4.25%. That same $2,500 payment only buys you $508,000 of house now. And pop that up to 6.25%, that exact same payment only buys you $406,000 of house.
So how does that drive prices down exactly? It's not a one-to-one, a tit for tat type of thing. If it was, we would see an immediate price reduction that ties to a specific interest rate, but we don't, and we didn't. Even when prices started going up, the housing market was strong. Refinances went way down, but the real estate market was still kicking.
So how does it drive prices down? Because as interest rates have continued to bump up, the number of buyers who could afford $575,000 started to decrease. Because if that was their max affordability and the interest rate increase makes their max affordability now only $500,000, there's less competition for that $575,000 house. But because there's a supply issue, there are still buyers at $575,000. So we didn't see an immediate price crash.
But as interest rates have continued to go up, and are continuing to go up, The buyers who can afford $575,000 have significantly dropped. Even buyers who could afford a $690,000 when interest rates were in the low threes are only qualifying for $487,000. So every time the interest rate goes up, buyer demand at any particular price point is going down.
Since everything about housing prices is related to supply and demand, and supply having stayed the same, but now demand, or number of buyers who can afford that house at that price, has gone down. If demand goes down enough, it inverts the supply and demand curve. And now there's more supply at a certain price than demand.
When that happens, the only thing that can happen is for prices to drop to a point where the supply and demand curve are in equilibrium. Now, all that said, what do we expect to see in 2023? If you're a real estate investor or wanting to become one, what we see is so much opportunity.
Hey guys, want to make an early New Year's resolution? How many doors do you want to accrue in 2023? Drop your number below. We haven't stopped buying now, even though we do expect prices to drop in the future. We currently have 7 different properties under contract, plus another 300 plus unit property that's going to close here in the next week or two.
And why is that? Why on earth would we be buying now when we think prices are going to drop?
Well, for starters, we buy for cash flow, and interest rates are continuing to rise, which means we'll have more cash flow if we buy while rates are lower. Prices will probably go down for a while, but what do we care? We're in this for the cash flow. Eventually, prices are going to go back up. And it truly doesn't matter to us until we get to some point in the future when we would want to sell.
But when is that? When would we want to get rid of those properties that cash flow?
Never. Well, maybe eventually we'll be tired of having so many properties, and then we'd sell them to maybe consolidate into fewer properties. But that's not going to be for a while. The other time it would impact us is if we wanted to refinance. We want our property value to be as high as possible so that we can potentially pull cash out so that we can reinvest into more properties.
So if prices haven't gone up, we might just have to stick with the property, with the current loan, and just enjoy the cash flow it already produces. For investors, the past several years have been challenging. You'd think interest rates being low would make for an ideal situation, right? In theory, yes, money is cheap, so cash flow is high.
The challenge has been that because interest rates were low, there were so many more buyers, which made it hard to actually catch a cash flow fish. You'd have to write a lot of offers before even getting one accepted.
A cash flow fish?
You know. Now, a lot of investors that don't know any better are going to move to the sidelines because they're not used to these higher rates. The rates we're going to start seeing are the same ones that we were accustomed to back when we got started.
Yeah, so this is very familiar territory for us because some people don't know how to adjust, or they're afraid because they've never worked in an interest rate environment like this. There are fewer buyers for the properties that we like, and fewer buyers means less competition. Less competition means more properties we can buy without having to do something crazy like pass on an inspection, which we will never do, at least not again.
Anyway, in conclusion, what do we see coming in 2023?
Lower prices, tons of opportunity.
Regular people will be afraid, and that is our prime time. Pick up properties while they're easier to pick up. Yes, we'll have to pay higher interest rates, but eventually interest rates will chill out and they'll go down. And in the meantime, we'll be building our empire and we can refinance into better rates down the line. And as long as the property is cash flow now and you're satisfied with the cash on cash return, you're going to be in an ideal position if you can get yourself into the game now and continue on through the next few years.
If you guys have questions and need answers about getting into real estate, we would love to invite you to our free live Ask Us Anything. Whatever questions you have about real estate, come by and join us. We'll put the link below. We'll see you next week.